So have you ever stopped to think about how your favorite trading app lets you buy and sell stocks for free? I mean, zero commission trading has totally changed the game for us regular investors, right? But it's all powered by this, complex and pretty hidden engine. Well, today, we're going to pull back the curtain and see exactly how it works.
All right, let's just get right into it. This is really the multi-billion-dollar question, isn't it? If you're not paying a commission to trade, how in the world are these brokers making their money? I mean, somebody has to be paying them, right? And what exactly are they paying for? That's the big puzzle we're going to solve today.
You know, the shift to free trading happened so fast, it was kind of crazy. It all started with Robinhood back in 2013, but the real earthquake hit in 2019. That's when the big players, we're talking Schwab, E-Trade, TD Ameritrade, all dropped their commissions to zero just to compete. And then, bam, 2021 rolls around with the whole meme stock mania, and suddenly this business model is front-page news. Everyone was asking, wait, how does this actually work?
And this whole revolution brought a completely new generation into the market, a much younger one. Think about it. The average Robinhood customer is only 31 years old, and their median account balance? Just $240. So zero commissions didn't just cut costs, it basically threw the doors open and democratized access to the markets, for better or for worse.
Okay, so we've set the stage. We've got a whole new wave of investors trading for free. Now let's follow the money trail and really unpack the business model that makes this whole thing tick.
So, when you hit that buy button on your app, say for 100 shares of Apple stock, you might think your order just zaps right over to the New York Stock Exchange. But it doesn't. Nope. It actually takes a really crucial detour first. Your broker sends that order to a middleman, a massive trading firm known as a market maker or a wholesaler.
And right there, in that detour, that's where we find the answer. It's all powered by something called Payment for Order Flow, or PFOF for short. Put simply, these market makers pay your broker for the right to handle your trade. We're talking tiny payments, often just fractions of a penny per share. But when you add them all up, that's what completely replaced the old commission fees.
You know, there's this fantastic analogy from some researchers at the London Business School that just nails it. It makes this whole hidden cost thing super easy to understand. Think of it like this. You avoid paying that obvious commission fee, but you might be paying a hidden one through a slightly worse price on your trade. That's the bid-ask spread. And that's exactly where the market maker makes their profit.
Okay, let's break this down into 4 simple steps. 1, you place your order in the app. 2, your broker doesn't send it to an exchange. They route it, or really sell it, to a market maker. 3, the broker gets paid that little PFOF fee for sending them your business. And 4, the market maker executes your trade, trying to make a tiny profit on the spread. It's a classic high-volume, low-margin business, and it's the engine that powers this entire free trading world.
But here's the kicker. Not all order flow is created equal, not even close. Just look at this breakdown. A whopping 65% of all PFOF revenue comes from options trading. 65%. So why is that? Well, because options are way more complex and have wider spreads, which means they're way more profitable for the market makers, and in turn, for the brokers who send them those orders. This creates a huge, powerful incentive for brokers to, let's say, encourage their users to trade riskier stuff like options.
And that brings us right to the heart of the great PFOF debate. So we know how it works, but is it actually a good thing? Is it this brilliant innovation that makes trading cheaper for everyone? Or is it a fundamental conflict of interest where the broker's profits are put ahead of what's best for you, the customer?
Honestly, the arguments on both sides are pretty strong. On one hand, the supporters will tell you, hey, PFF is the reason we have zero commission trading. It adds liquidity to the market, and you can even get price improvement, which means getting a slightly better price than you see quoted. But then the critics fire back, saying the conflict of interest is just baked in. They argue it can lead to worse execution prices overall, and like we just talked about, it pushes brokers to promote riskier trading.
And make no mistake, this is not just some sleepy academic debate. The head of the SEC, Chairman Gary Gensler, has come out and said it himself. He called PFOF an inherent conflict of interest. I mean, when the top regulator in the country uses language that strong, you know this practice is under a microscope.
Now, it's really important we bust a few common myths you might hear about PFOF. First off, it is not the same thing as illegal front-running. That's a different beast. By law, market makers have to give you a price that's at or better than the nationally recognized best price. Second, for most of us who are long-term investors in big liquid stocks, the actual cost impact is tiny. We're talking fractions of a penny per share. And finally, for a lot of the big brokers firms, PFOF isn't even their biggest moneymaker. They actually make more from the interest on the cash sitting in your account.
But just because the cost per trade is negligible doesn't mean this is small potatoes. Oh no, far from it. In 2020 alone, the top 7 U.S. retail brokerages raked in over $2.6 billion from PFOF payments. That's not a side hustle, folks. That's a massive, central pillar of the entire industry's business model.
So with all this regulatory pressure and public debate swirling around, you have to wonder, what's next? Brokers are for sure already thinking about this. If PFOF gets banned or seriously restricted in the U.S., how are they going to replace all that revenue?
And this isn't just a what-if scenario. The European Union has already made up its mind. PFOF is officially getting banned across the EU, starting in 2026. A move like that is sending massive ripples through the global brokerage world, and, well, it's forcing these companies to get creative. So, what's the next big thing? What's the heir to the PFOS throne? Well, a lot of signs are pointing to something called securities lending. Here's how it works. Your broker takes the shares you own and loans them out to other big players. Think hedge funds who want to short the stock. In return, you, the investor, get a small piece of the lending fee. You'll see it marketed as a slick, new passive income feature.
But as always, there's a catch. There's a new trade-off. Sure, you might earn a little extra cash on the side, but you're also fundamentally changing your relationship with your stock. You go from being an owner to being a creditor, and that brings a whole new set of complexities, like counterparty risk, what if the borrower goes bust, and it can even mess with your ability to vote your shares. So really, we're just swapping one set of hidden complexities for another.
Okay, so after digging through all of that, what's the bottom line for you, the regular investor? What are the key takeaways you need to remember as you navigate this world of so-called free investing?
It really all boils down to this one simple question. Whenever a service seems free, you have to ask yourself, what is the real product being sold? In the world of zero-commission trading, the product is you. Well, more specifically, it's your order flow. All of our trades, bundled together, are an incredibly valuable commodity that gets sold to the highest bidder. Now, understanding this doesn't mean you should stop trading, not at all. But it empowers you. It lets you see the market for what it actually is, a super complex system of incentives where, at the end of the day, nothing is ever truly free.
This is not financial advice.